Well, hey there, and welcome to today's explainer. If you've ever stared at a business ledger and felt like you were trying to decode some ancient, completely undecipherable language, you are absolutely in the right place. Today, we're going to demystify double entry bookkeeping. And the best part? We aren't going to do it by just staring at dry, abstract textbook theory. Instead, we are taking a super practical journey through a real business day at an agri-fishery cooperative. We're going to see actual money changing hands, goods literally moving out of the warehouse, and services being rendered. And we'll map every single one of those tangible actions directly to the financial books. By the end of this, I promise you, you'll be reading these ledgers like a seasoned pro.
All right, let's just dive right in. Our source material today is grounded in something incredibly practical. The training exercises from the Bangsamoro Agri Fishery Training Initiative, specifically focusing on the operational phase of an agricultural co-op. So these aren't some hypothetical pie-in-the-sky numbers, right? These are the actual everyday transactions that keep a farming co-op running, keep it supporting its members, and ultimately keep it financially afloat. We are looking directly at the beating heart of their business operations. To make this super easy to follow, we're going to tackle this day in 5 quick steps: cash sales, credit sales, collecting dues, tractor services, and we'll wrap it all up with the financial harvest.
Okay, section 1, cash sales. Let's get to our very first transaction of the morning.
Picture this. The sun is up, the co-op doors are officially open, and your very first member walks up to the counter. Here's the scenario straight from the training materials. They desperately need fertilizers for their fields. So you hand over these heavy bags of fertilizer, and in return, they hand you 10,000 pesos in crisp, physical cash. Now, behind the scenes, we know for a fact that the cooperative originally bought those specific bags for 7,000 pesos. So we've got two very real things happening simultaneously here. Cash is coming right into our register, and physical inventory is leaving our warehouse.
So, here's the big question. How do we actually translate that physical reality into the language of accounting? How do we record both the joy of making a 10,000 peso sale and the reality that we just gave away 7,000 pesos worth of our hard-earned inventory? Take a quick mental second to think about how you might balance those books. Okay, so what's really fascinating here is how we have to split this single real-world event into 2 totally distinct accounting entries. First up, the sale itself. We write debit cash, 10,000, because, well, our physical cash went up. And we credit sales, farm inputs, 10,000, to record the revenue we just earned. But we aren't quite done yet. For the cost side of things, we have to log the fact that we lost that inventory. So we debit cost of sales, 7,000, to record the expense, and we credit inventory, 7,000, to show that our stockpile of fertilizer has literally gone down. It's really just a perfect mirror of physical reality.
Moving right along, Section 2, Credit Sales. This is all about the promise to pay.
So it's mid-morning now, and another farmer rushes in. But this time, it's a little trickier. This farmer urgently needs seeds to plant before the rains come, but they just don't have the cash on hand today. Now, because this is a cooperative built entirely on mutual trust, we allow them to take the seeds now and just promise to pay us later. They are taking 8,000 pesos worth of seeds. Behind the counter, we know those seeds cost the co-op 5,500 pesos to acquire. So the seeds leave the building, but our cash register, it stays completely empty.
All right, here is your next puzzle. Think back to that fertilizer sale from a minute ago. We had cash coming in, so we obviously debited cash. But here, we have 0 cash coming in today. So what specific account replaces cash in our journal entry to represent this farmer's promise to pay us in the future?
If you guessed accounts receivable, spot on, you absolutely nailed it. Instead of debiting cash, we debit accounts receivable members for 8,000. This is an asset, just like cash, but it essentially represents an IOU. We still credit sales for 8,000 because technically speaking, we did earn that revenue today. And for the cost entry, it remains exactly the same as our first scenario. We debit cost of sales for 5,500 and credit inventory for 5,500 because just like the fertilizer, those seeds physically walked out of our warehouse.
This actually highlights a massive, fundamental divide in business operations. On the one hand, a debit to cash represents immediate liquidity. You can literally use that money today to pay your own bills. On the other hand, a debit to accounts receivable, that's a promise. Yes, it's legally binding, yes, it's valuable, but you can't exactly buy lunch with an IOU, right? Understanding that difference is the absolute key to grasping cash flow in literally any business, but especially a farming co-op.
Okay, Section 3, Collecting Dues. Time to cash in.
Let's fast forward a few weeks in our co-op's timeline. The seeds are in the ground, the farmer has a little extra money rolling in, and they return to the cooperative. The scenario is pretty straightforward, but it's absolutely critical for survival. That member who bought the seeds on credit walks back into our office and hands over the 8,000 pesos they owed. We are finally getting that cash in hand. Now put your accountant hat on for a second. You've got a slight dilemma. Your cash drawer just went up by 8,000 pesos. But remember, we already recorded the sale weeks ago when they originally took the seeds. So how do you balance this new influx of cash today without accidentally recording it as a brand new sale and totally messing up your revenue numbers? The solution? It's honestly wonderfully elegant. We debit cash for 8,000 because, well, we physically received 8,000 in cash. Simple. But for the credit, we don't touch sales at all. Instead, we credit accounts receivable members for 8,000. By crediting that exact account, we are effectively zeroing out the farmer's debt. That IOU is completely canceled out and transformed perfectly into liquid cash. Next up, Section 4, Tractor Services. Let's talk labor and machinery. Let's throw a completely different type of transaction into the mix just to broaden our skills here. So far, we've only dealt with physical things, right? Fertilizers and seeds. But what if we're dealing with labor and machinery? Here's the scenario. A member needs to plow their field. The co-op owns a tractor. So we send our tractor and a driver out, they do the hard work, and the farmer pays us 6,000 pesos in immediate cash for the service. Notice the massive difference here. We aren't handing over a bag of goods. We aren't reducing our physical inventory. We still completely own the tractor at the end of the day. We literally just rented out its capability.
Finally, Section 5, the financial harvest. Time to total those ledgers.
We have seen a lot of action today, haven't we? Cash coming in, inventory going out, promises made, and promises kept. Now it's time to extract the real wisdom from all of this. If you take absolutely nothing else away from this explainer, please memorize this universal two-step framework. We pulled this straight from the source exercises. Whenever any transaction happens, just ask yourself two things. Step 1. What tangible thing did the co-op receive? Did we receive cash, an IOU? Whatever we received, that's almost always our debit. Step 2, what did the co-op give away or earn? Did we give away physical inventory? Did we earn revenue from a sale? Did we provide a service? Whatever we gave or earned, that is our credit. It really is that simple.
And when we apply those rules, 4 fundamental operational truths about our business just kind of pop out. Number 1, cash sales immediately boost our liquidity. They give us money we can spend right this second. 2, credit sales build our receivables. Sure, they generate revenue, but they tie our money up in promises. 3, collections are that magic moment where those promises finally convert into usable, spendable cash. And 4, services are totally unique. They generate direct income based on our assets and our labor, without draining our physical inventory stockpiles at all. Every single entry we made today tells a really vivid story about the health and the day-to-day reality of the cooperative.
Which brings us to our final challenge for the day. Remember that tractor service scenario we just discussed? We received 6,000 pesos in cash for doing the plowing, but we actually didn't show you the answer key for that one. So, based on that universal two-step rule we literally just covered, what exact accounts would you debit and what would you credit to log that tractor service? Really think about what we received and think about what we earned without giving away any inventory. I'm going to leave you to puzzle over that journal entry. Thank you so much for joining this explainer, and hey, keep looking for those real-world stories hiding inside the numbers.